you sell an asset, you pay capital gains tax. But because you depreciated that asset, a portion of the capital gain is going to be subject to recapture, so you're going to pay a higher rate.
And do you get the same advantages with REITs? I'm assuming no, right? Because REIT is essentially like a piece of paper that you're holding.
Right. So REITs are treated more like investment vehicles, similar to equity, stocks, bonds in the market. And so they have different requirements in terms of how they have to distribute the majority of their profitability or their cash flow throughout the year. But those are treated very similar to stocks. And so you don't necessarily derive the same benefits as you would going directly into a syndication.
And, say some of the investors are going to be in their W-2s, right? How is this important to them? Because essentially this is like these losses that come to them. Larry, a lot of my listeners may be like high net worth individuals who are on their W-2 working full time, maybe physicians, right? How would they leverage this depreciation if they're investing in a syndication when they're actively working a W-2 job? What advantages do they get from these tax deductions?
Yeah, I really love this question because I get this quite often, especially when folks will come back and they'll say, "Hey, my advisor or my tax person told me that there's no benefit to me investing in this thing. I'm not going to get any write-offs." And as I always say, "Hey, pump the brakes. Let's look at the full picture." So for a high net worth individual who's making or high income earning individual rather, who's making a passive investment inside of a syndication, when those negative K1s come back to you, you are beyond what the IRS has called the passive loss limitation. You essentially earn too much money to take full advantage of the loss. And so essentially what they tell you is that to use it right away, you either have to have other passive income, which we're going to talk about because that's important to offset it, or you have to have sold that property and there has to be a gain in order for those losses to be used, a passive gain in order for those passive losses to be used, or you have to qualify as a real estate professional and all these different parameters. But let's keep it very simple and basic. The first thing that we'll want to understand is that typically, if the property is cash flowing appropriately, you're making more money, but you're not paying more tax. That's the first thing to understand. Even though you may not be able to use the negative K1 in year one, ideally, you're getting a return of your capital or perhaps even a return on your capital. But the point is, you're making money, but not necessarily paying more tax. The second thing is, well, now we get strategic in terms of how and where we place our investments. Passive losses can only offset passive income. So if we invest in a passive real estate deal, is there another passive business that we don't participate in that we can invest in that cash flows, where we can use the losses from our real estate to offset the income from this other business? We see this with physicians quite often, especially when they invest in other practices or other surgery centers that they don't necessarily participate in, but they're silent investors over there. Well, now their multifamily syndication has large K1 losses. Their practice over here that they don't participate in has taxable income. Those two come together, and if you remember what we said at the beginning, you're making more money, but you're not paying more tax. By the way, you're also getting cash flow from your real estate. That could be a very powerful wealth building strategy or something to consider. If they are fortunate enough to qualify as a real estate professional, which takes a lot of different parts, moving parts coming together, then they could possibly use those losses to offset active income from the W-2 or from their other businesses.
Yeah, and I'm glad we're talking about real estate professional status. I'm not going to get into the details of real estate professional status, but I do want to talk about, the short-term rental loophole that exists, because I think that's an easier test to meet in terms of the IRS, and I would love to hear your thoughts on that and how people can leverage that to actually offset some of their active income.
Yes, yes. So the short-term rental loophole is a very unique strategy, especially for high-income W-2 earners, where if they're interested in stepping into the short-term rental space, what some people call Airbnb, VRBO, and so on and so forth, it can provide massive tax benefits without all of the parameters that are required for real estate professional status. So here's what you essentially have to do. Number one, you have to actually own the asset. So for those that are in the arbitrage space of short-term rental, this isn't necessarily for you. This is for those who actually own the asset that they're going to be operating as an STR. One, the average stay of your customers, of your clientele, has to be 7 days or less. Does that mean some people can stay longer than 7 and some people shorter than 7? Sure, as long as the average stay of your bookings, the average stay of your clientele is 7 days or less. That's number one. And number two, you have to do what's called materially participate in the short-term rental activity, which basically means you have to manage it, right? You want to vet your clients. You want to manage your cleanup and changeover crew. You want to manage the property itself and different things like that. You want to actively play a role in managing the short-term rental. When those two things are true, if there are losses produced from that short-term rental activity, those can flow through and possibly offset the active W-2 income. So a lot less stipulations than the real estate professional status, and it could have massive tax benefits, excuse me, especially when you layer in a cost segregation study.
Right. And I just want to tell everybody, folks, we're just having this conversation where, even though Larry is an expert at what he does, he's not your CPA. So make sure you talk to your professional, your CPA or your tax strategist before you take any decisions regarding your taxes. This is just for education and just for information.
Absolutely. Love the disclaimer. We may have to loop that back to the beginning, right?
Yeah. Well, I think, I usually add a disclaimer in the beginning, so we should be good with that. But just to, let everybody know this is just for information purposes only. Larry, I want to talk a little bit about, gas and oil, because that's one space that I'm not very familiar with. And I would love to know, what are the tax advantages? Are they similar to real estate, or what are the nuances there? Like, say somebody wants to invest in oil or in gas, how do they do that?
Estimate to using leverage and accelerated depreciation. What typically happens when they're investing in oil and gas is they have these companies or these organizations that are doing drilling. And we know the type of equipment that's required with drilling, right? It's not just some
Right.
6,000 pound vehicle you're going to buy. This is heavy machinery that costs a lot of money. Essentially, what these partnerships do is that they finance the equipment. And so, yes, they'll raise the capital. And when you finance something, you got to put a down payment, but then you take
Right.
a note, you take debt service on the remaining amount. And so they're able
Right.
to finance millions of dollars worth of equipment that's needed to go do the drilling or whatever work is required in the oil and gas space. Accelerated depreciation is the name of the game here. That equipment, the depreciation on it is able to be accelerated, right? Because the useful life is below the standard. So they can take a huge deduction right away in year one, even though, because no oil or gas or anything like that has been produced, even though there's no cash flow that's been produced. And so that's where you can get some major tax benefits there. Now, you have to be aware of the long-term play there, because oftentimes you can get huge tax benefits in year one, but then in year two, because there's a ton of debt service that needs to happen to service the equipment debt that they took out, the cash flow in year two or even beyond may not match the tax implications that you're going to have. And so you just want to balance those out appropriately. So that's really the initial value that a lot of folks derived on the oil and gas space. The other side, for folks who were fortunate enough to inherit some of these wells or inherit some of the royalties, they receive royalties from the oil and gas wells that perhaps their family has owned for generations. Well, that type of income is taxed fairly passively, which basically means it's not subject to employment tax, Social Security, or Medicare tax. So that comes to you favorably when you receive rental and royalty income. So those two ways could be very beneficial when it comes to oil and gas.
Very cool. Very cool. And I want to touch on, the tax deferred accounts like our IRA accounts and 401k accounts. Are people able to invest with those accounts into different alternative asset classes? Because traditionally, the 401ks, everybody will invest in these mutual funds, and there are these companies that do that. So how can people take advantage of the money sitting there? How can they tap that to invest into real estate or other tax advantaged investments?
Yeah, that's a very important question too, because for most of us, especially as we go through our initial working years, a lot of our savings or our money is trapped inside of retirement accounts, that being 401ks, IRAs, and the like. So the first part, let's talk about the tax savings, and then we could talk about usage afterwards. Typically, especially for those of us who have been in W-2 jobs, you know, once you join an organization, if they have a retirement plan, you make a contribution. The company sometimes makes a matching contribution, and there may be some profit sharing. And that's your retirement account. That's your retirement chassis that grows over time. It could be a SEP IRA, could be a 401k, could be a simple IRA. It's a retirement account nonetheless. The rules around that retirement account are that you cannot touch it until you reach age 59 and a half. If you touch it before then, there's a nasty little 10% penalty, and whatever excess you take out is considered taxable income to you. Well, if you have a large amount that is invested in these accounts, maybe you want to be in the market, maybe you don't. In many cases, you can roll these accounts over into self-directed vehicles. 401ks will have some stipulations, especially with the plan. They may require you to have left your employer or something like that. But the point is, if you have the opportunity, you can roll it into a self-directed vehicle, self-directed IRA, self-directed 401k, self-directed SEP IRA, or anything of the like. From there, you can invest that money in other passive investments. Real estate is the more obvious one. Some people do lending where they'll receive interest income back. As long as it's passive in nature, you can invest your money there and then it grows your retirement account over time. So it gives you a little bit more control over how you use those funds.
Right. And lending is typically, is taxed as portfolio income, if I'm not wrong.
That's correct. Yep. Because it's considered interest income that you're earning.
Right. And let's talk about that because I think that's another interesting space, right? Because some people may not necessarily want to invest into a syndication or may not want to invest into a particular asset, but they may be okay lending money to somebody. So
hmm
how do they take advantage of taxes or how are they taxed differently from other investments?
Yeah, so if they do this inside of their self-directed retirement accounts, then of course it's allowed. It's considered interest income that they're earning, and all that money goes back to the retirement account. Now, the rules are you still can't touch it until you reach 59 and a half, but it gives you a lot more flexibility and control over where you invest your funds. For those who are fortunate enough to have enough money to do private lending outside of their retirement account, well, that money is treated similar to rental income, where it's passive in nature, and so the tax implications there are essentially just your federal income tax bracket, maybe your state tax bracket, depending on where you live. If you're not fortunate enough to be in the great state of Texas or some of the other folks that have no state income tax, so you may pay taxes there, but essentially you avoid Social Security and Medicare tax, or what some people call payroll tax. That's an immediate 7.5 to 15.5% savings.
Right. I want to talk, more about your thoughts on actually keeping a 401k or keeping, an IRA. And the reason why I bring this up is because I've had this conversation with my investment advisor quite a few times, and he advises me to continue my 401k and continue putting money into this. But I know that there are factions that say, well, it's not there's no point in putting money into your 401k. You would rather invest it yourself. But at the same time, if you don't put money into your 401k, you're hit with a higher tax bill. And I'm just curious, where do you stand on this?
So I like diversification, right? Short of rendering any specific advice to anyone, I like diversifying. And diversifying, basically diversifying in asset classes, but also diversifying in pre-tax and post-tax buckets. So I always think that there's some value in saving a dollar today, right? And so not paying tax on some money today. So the pre-tax strategy is valuable. And conventional wisdom tells us that, look, tax rates are probably going to go up. And so sometimes it makes sense to just bite the bullet and pay the tax today and focus on your post-tax strategy. I think one should have both. An individual should have both in play, and it gives you the flexibility to 1 year save money because you're in a high bracket, so we need to squirrel away as much as possible. Other years you may be in a lower bracket, and then we can hyper focus on our post-tax strategy. So I like having both of those options available.
I like that. I like that because I think it depends on your individual tax situation and it varies from year to year. And I've never thought of it from that perspective, like how it can be different, right? And, obviously we've talked about this and I can clearly see that, the amount of value that you bring to investors, but how do you really help investors as a tax strategist, particularly real estate investors? Like, when do they get in touch with you? How do you work with them? What do you help them with?
Yeah, that's a really good question. And so we focus on more of a holistic kind of what I call a 360-degree view of an individual's financial situation. And we look at it purely from the tax perspective, but we want to know everything, right? We want to know how you make money. Is it W-2? Is it a business? Is it interest income, rental income, royalties, whatever it is? If there's a dollar coming into the household, we want to know about it. And then we devise a strategy or a plan to help structure that in the most tax efficient way. For some people, that's looking at their business and how the entities are structured. For other folks, that's looking exclusively at the post-tax strategy because there aren't a lot of pre-tax opportunities. But whatever it is, we try to derive some value by structuring and saying, like, look, if we do these things today, it helps our tax bill in this particular way. And again, not everything's a slam dunk and a home run right away in year one. Some things are a longer term plan, depending on what's happening with the individual. But the goal is no surprises. As you leave the year, you should know exactly what your tax bill is. And you should know that that we've done everything we can to get that number as low as possible. And that's essentially what we look at from the tax planning piece. And of course, we'll look at other things involving the business as well. But when we talk taxes, 360-degree view.
Very cool. Very cool. I know that we've had this discussion, of course, before, and I know that we're going to be having you as our tax strategist at the asset level, which I think does help, not only helps us, but also helps our investors because we can operate in a very tax efficient way in all of our acquisitions and our businesses that we do, right? So I'm very excited to be, working with you on our acquisitions in the future. But, if other people want to work with you, how can they get in touch with you?
Yeah, so there are two ways. The first way is you visit our website, which is pb-strategies.com. And there's a big blue button right at the top right that says Become a Client. You click that button and someone from our team will schedule a strategy call, a discovery call with you, and we'll talk through your situation, share a little bit more about our company and see how it makes sense for us to work together. But there's another way that we just started working on, which is very exciting, and I'm telling you, it's really refreshing, where we have a Facebook group called The Strategy Room. And that's where we do many weekly Zoom strategy calls and different things around tax strategy, business strategy, and wealth planning that give you a behind-the-scenes look at how a lot of these things go if you don't have immediate access to a tax strategist. And so either of those ways, I think, would be super fun and dynamic.
Very cool. Very cool. Thank you so much, Larry, for joining me today on this podcast. I think this has been a lot of fun and a lot of information that you've shared with us today. And I really appreciate your time.
Hey, thanks for having me. This has been a blast.
Thank you so much. Take
Thanks.
care. Guys, if you haven't done already, please go check out my free video series on how to do due diligence on operators and on deals before investing in them. It's called Real Estate RX for Passive Investors, and it's available at www.rerxcourse.com.